our stock of the day, thought we'd take a look at Endeavour Group. Shares under some pressure in today's trade after reporting full year profit after tax 529 million, missing market consensus, but up around 7% on the year. Group sales were also higher, 2.5%. To just under 12 billion. Group earnings before interest and tax rose 11%. Board announced fully franked dividend 75 cents a share. That's down from the previous 77 cents. Carl, Endeavour was always seen as one of those stable stocks during an economic downturn, a defensive stock. They report today, the market's taken a bit of a cane to them. What do you think of the update in the share price at the moment?
Yeah, look, you make a really good point there about Endeavour being defensive. And I think there's always been this sort of premium built in since COVID for that defensivity. I've just made up a new word there, COVID, to David Koshi. So where it all changed for me for Endeavour, and this is one, I'm just looking at the chart here. We've got the chart up on screen, but that chart's not going back far enough to August last year, where they had that big profit downgrade.
Right.
And it was just sort of chugging away. And I had longs on this. I was tweeting it. I had clients in this. And then out of the blue, maybe you can see it there. There we go. Yep. So you can see the big peak there. Big profit downgrade, fell from 840 to 730 in a flash. And that it's a big black candle and a big gap. And that's where I basically have to tell anybody who follows me, okay, we're on the way out the door now. Might not be today, but we are working our way out of this. And honestly, it has not seen barely an uptick since then. It just goes to show once you disappoint the market, once you lose the faith of the market, just how hard it is to get it back. And I think we've just seen, as you say, that premium be eroded. So it was trading, not that long ago, it was trading sort of mid-20s on its PE. And that's come down to 18. Which is still expensive. It's still expensive for this type of company, which is going to deliver us all of about 4% compound annual growth over the next 3 financial years. So, your typical ASX stocks, I'm just going the average here, it's going to give you sort of, 7-8% growth, and it's going to have a PE of around 15. So we're getting less than the market's growth for more than the market's PE, and that PE continues to contract. Some might say, I'd like it for the dividend yield. Well, the dividend yield is about 3.8%. It's not awful, but now below 12-month term deposit rates. Plus, you've got that awful chart, short-term downtrend, long-term downtrend. I just can't find a reason to own it right now. So if I can't find a reason to own it, I must go sell.
Okay, all right. I'll tell you what, Michael, after Woolies split it out, this was a darling of the market for so long, wasn't it? They said it would shoot the lights out. This is the new sort of Bunnings, Wesfarmers type category they put in, because they have Dan Murphy, they have BWS in it, hotels, poker machines, the whole lot.
Yeah, so they're basically the third largest gaming operator in the country behind Crown and Star. They've got over 12,000 poker machines.
I didn't realise that. It was that many. I knew they had pokies, but the third biggest, wow.
I think 300 different venues, and that's one part of their business, and that was struggling during COVID. Then you obviously had the retailing liquor businesses, BWS, Dan Murphy's, which was performing very well.
Yep.
You've had these sort of businesses start to oscillate as things normalise, back to whatever normal is. So it's very difficult for the market to gauge where everything's going to basically stabilise in terms of the liquor business, which actually saw a slight decline in revenues. Then you also had the big pickup in their entertainment side of things, which is the pubs and the poker machines. Yep. So, look, business is still
and a couple of state governments really putting restrictions on the pokies too.
And this is the problem across a number of jurisdictions. I think Victoria's been first cab off the rank.
Yep.
New South Wales have been discussing things, Tasmania as well. So that is, I think, part of the re-rating that's going on, because, a 20% drop in gaming revenue for them would have a fairly significant hit to their earnings. I think some people are estimating 20 to 30%, even more. So that's something that I think the market's just been digesting as well in recent times. It's hard because the liquor business is a very mature business. Obviously, yes, a lot of the population do drink and go to bottle shops, etc., but it only really grows at the rate of population growth. And that's probably why, as Carl touches upon, the earnings growth for this business is around 4% per year. So it's nothing too exciting, and the valuation's nothing too compelling either. They've had a couple of bad updates recently, missing consensus over the last 6-12 months. So probably best to give this one a wide berth for now, and maybe focus in on it once it starts to bottom out.
So if you're in it, sell it as well.
I would sell it. There's probably better opportunities at the moment, in our opinion.
Okay, Carl quite rightly talked about disappointing the market, big reputation. How long does it take to get that confidence back in the market? Sort of, if you're an investor that you've had CSL is a classic example. One downgrade, and the theory is you never buy in a downgrade cycle. Then they reported well, they bounced back up. Is that just a quality outlier stock? What's the norm in terms of getting?
I think once you start to see the commentary from management improve and maybe start to exceed expectations again, that's normally a good opportunity, we think, to start at least looking at it again. You saw a similar thing with Megaport. Megaport almost had 3 or 4 poor updates in a row. All of a sudden they've had 2 good ones in a row, and the share price has gone back from, we went from $20 down to like $4, $5, now it's back above 10. So I think if you can clearly see there's been a shift in the momentum of the business and the commentary coming from management, that's often a good opportunity to jump in.
And Carl, you would see then that reflected in your volumes and your candles and all that sort of stuff.
Absolutely. But even better, Koshi, you're going to see it reflected before that result comes out. And this is the beauty. If I can summarize the beauty of technical analysis, it is this. Because when that surprise beat is coming after that huge earnings downgrade cycle and the price has been beaten down, the fund managers know that things are improving. They talk to insiders.
Whoa. That's meant to be all secret, isn't it? Continuous disclosure to the total market. What are you saying?
But a lot of it's above board. They'll have analyst meetings, analyst presentations that we're not invited to. But hey, the team at Macquarie Bank, they're invited, or they'll go to a site visit at the company's operations. And I'm generalising here, but I tell you what, Koshi, the fund managers know that upgrade's coming, and it changes the demand-supply dynamics in the market. Fund managers who own the stock, they stop selling it, and fund managers who have cash to apply, they start buying it. Demand greater than supply, price turns up. I've seen it so many times in the last 6 months, particularly, I know this is so off topic, but all of those retail companies, Koshi, the retailers and a lot of the big technology platform providers, your REAs, your car sales, your domain groups, Seek, I know that had a little bit of a miss, but all of those charts started turning up. And I'm not going to toot my own horn here, Koshi, but I got clients, I got my followers into a lot of those turnarounds before they happened. Nick, Scarley, so many of them, and you will see it. It is, the fingerprints are all over these things before that upgrade cycle begins.
Interesting. All right.